Hello everyone and welcome back. We do hope you're all keeping safe and well in these difficult times, and thank you very much for joining us all for this 2021 BKL budget webinar. I'm Anthony Newgrosh and I'm delighted to say that joining me today are Daniel Shear. Hi Dan.
Hi, good afternoon.
And Chris Smith.
Hello everyone.
Joining me over the ether, so I do hope you both paid your phone bills, chaps, but in a minute we'll start picking the bones over yesterday's budget announcements. As always, we do welcome your questions, comments and feedback, so do feel free to type away. And our wonderful producer, David Goldstein, thank you David for all your hard work. We'll keep an eye on those and we'll do our best to answer as many as we can during the webinar. If not, don't worry, we will come back to you as best we can individually if there's questions we haven't had time to cover, and we will be sending out both copies of the slides and a link to this webinar should you choose to listen again in due course, so everyone's a winner. So, okay, let's turn our attention to yesterday's budget. A bit of a, perhaps, may I say, a Man United budget. Promised a lot, but a bit of a damp squib in the end, perhaps. But let's see what we can do to pick the bones out of it over the next 45 minutes to an hour. So, chaps, maybe we'll start with you, Dan. What did we like about yesterday's budget?
Well, just for those people who don't know me, I'm the corporate finance partner at BKL. I'm not a tax expert, so I'm not talking as a tax expert, but as a corporate financier, I guess one of the things I obviously liked was the lack of attack on certain areas of capital gains tax, in particular business asset disposal relief or entrepreneurs relief, as it used to be known as, has remained. I've been working a lot recently on companies selling to employee ownership trusts where the sellers pay no capital gains tax on their gains, and there was a concern that might have been withdrawn. And again, at the moment, at least, that remains the case. We'll have to see what happens in the next budget. But certainly, in terms of incentivizing entrepreneurs, I was happy that hasn't been cut away. Other than that, damp squib. Yes, it was a bit of a damp squib. I heard someone refer to it as liken it to what happened in Y2K, for those of us old enough to remember, when everyone was worried that their computers and even their toasters weren't going to work on 1st of January 2000, and of course it turned out to be a lot of nonsense. And in a way, I think that's a rather reasonable analogy to yesterday.
Okay, Chris, anything to add on the positive side?
Well, I think from the personal tax front, we were relatively pleased that we didn't have drastic changes overall. It's, we know we're as we'll come on to, we're locked in for a period of time now without seeing substantial change. Yes, we may see some more things coming forward because he didn't touch upon certain areas, but on the whole, it was good that we don't have a drastic change in our working life, shall we say.
Okay. Anything we didn't like, chaps? Go on, Daniel.
Well, no, I was just going to ask you, what, as a sort of a business tax specialist, what did you like?
Well, there were certainly, as we'll come on to very shortly, some additional reliefs for the carryback of tax losses. That's welcome. A bit of a double-edged sword, that one, actually. So might cover that in both. What we didn't like as well, there's certain aspects there. There's the added incentives for capital expenditure. There's 130% tax relief we'll look at as well. So that's all good. But I suppose moving on to what we didn't like, the big elephant in the room is the very substantial increase in corporation tax that we'll look at next. Anything else from your side, Dan, that gets a thumbs down?
Not really. No.
Chris?
No.
I think that the fact that we didn't hear anything, I don't think we heard capital gains tax mentioned, which, whilst it can be a positive that we didn't see changes, in fact, we were quite mute on the whole topic. It would have been maybe nice to hear some kind of confirmation or at least some words on there. So it's more of what we haven't heard that I'm a bit wary about.
Okay, and you've sort of preempted the final question. What was conspicuous by its absence was the capital gains tax, and being a bit old and cynical, the first thing I did after the announcement was plough through all the announcements on the Treasury website just to see if there was anything in there, but no mention whatsoever. So, look, we may expect further changes down the line, but I think very welcome in it, as it were. No increases in CGT for now. Anything else to add to that, chaps?
Well, just a couple of areas. I mean, one thing that people were wondering was whether he was going to break the triple lock on pensions, which of course was a budget promise that they wouldn't. But given what happened with lockdown last year, it meant the pensioners are effectively winning twice, and there was nothing on that. So well done to the pensioners. Triple lock has remained. The other one was that some people were fearing that there would be some kind of wealth tax, a bit like they've got in France, as a way of perhaps repaying some of the deficit that's built up over the last year. So I suppose that's probably something I like rather than conspicuous by its absence. But obviously great news that hasn't been introduced.
Okay. All right, then, to start off with, we're going to look at the business tax changes. And as we said, I think not the biggest surprise. It was, about as predictable as England's batting performance in India at the moment, but somewhat surprising in the amount of the increase was the increase in the rate of corporation tax. It's not that long ago we were promised a 17% rate of corporation tax, and we've now jumped from a 19% rate currently to we're going to have a 25% rate, albeit not until the 1st of April 2023. So slightly surprising in this post-Brexit climate where we're meant to be encouraging businesses to stay and indeed come to the UK. But there you are. I suppose the crumb of comfort we can take is there is going to be a small companies rate where profits are less than £50,000. Those companies will still benefit from a 19% rate, albeit if you are turning back to old times, a so-called close investment company, so the majority of your income is from holding investments, then you're not going to get the benefit of that 19% rate. The Treasury says only 10% of companies will be liable to the 25% rate. But if you have a look at the Red Book, it does talk about this measure raising an additional £50 billion over the next 5 years. So it is a substantial tax increase, it would be fair to say. So we'll have to wait and see on that. Other points just to notice, we talked about 19% rate profits below £50,000, 25% if your profits are above £250,000. We're going to go back to the old days of marginal relief here. There's an effective rate of 26.5% between those two limits, such that we sort of claw back all the 19% savings, and once you get to 250,000, all of your profits are subject to a 25% rate. Those limits are divided by the number of associated companies, and I choose those words carefully. We did change away from associated companies, that's broadly the number of companies under common control, to 51% group companies. So you could have two companies owned by the same individual, they are associated but not group companies. Going forward, we're back looking at associated companies, and my reading of the changes is that that definition will also apply when we look at whether companies are in the quarterly instalments regime. So a few changes harking back to the good old days there, not all welcome, but as I say, not a surprise that corporation tax rates have gone up, but I don't think most of us are expecting a 25% rate. And that, of course, has other knock-on effects. For example, if we're looking at whether you have controlled foreign companies, overseas money box companies whose profits can be apportioned back to the UK. Your starting point is, are they paying tax at a rate more than less than 75% of the UK tax rate? So that will change. The diverted profits tax rate goes up also by 6% to 31%. So there's a penal additional rate if you're caught by the diverted profits rate. And this will also very much change whether we take dividends or salaries out of companies, which is the most tax effective. So we'll be looking at that, but it will certainly, I think, for larger companies, shift the equation back to taking salaries, which I suspect HMRC would probably prefer because they can get their hands on your cash straight away through the PAYE regime. So not good news, can't really dress that up any other way, I'm afraid. Let's have something a bit more positive, as it were, and that's the change in capital allowances. First point to note is this 130% first year capital allowance. Certainly, I've never seen anything like this before. This only applies to companies. Okay, so unincorporated businesses are not going to benefit. But broadly, what we're saying here is if you spend £100,000 on qualifying plant and machinery, you'll get a tax deduction, not a full first year allowance for that 100,000, but 130,000 off your taxable profits. So very welcome to encourage investment. Only applies to qualifying plant and machinery. Anything that will go in the special rate pool, so that's your air conditioning units, etc., lifts, solar paneling, I think is in there, etc., etc., that you get a 50% deduction for. And there's the general anti-avoidance is still there. If you are undertaking arrangements purely to take advantage of these rules, HMRC have the power to stop that, but you won't get these enhanced deductions for second-hand equipment, cars, long life assets, and assets for leasing. They're the general exclusions that are out there anyhow for first year allowances, so no surprises there. Bit of devil in the detail here. We do need to be careful. Disposal proceeds. Normally, if you make a disposal of plant and machinery, we take the proceeds to the relevant capital allowances pool, and that reduces your allowances going forward each year on a writing down allowances basis. Where you've claimed this 130% allowance or this 50% deduction, the proceeds you receive on those assets are immediately brought into the charge to tax as a balancing allowance or charge. So they're immediately clawing back the relief you might have. And further, the disposal value is 130% of the actual proceeds you receive for those assets you've had the 130% deduction. I think you can see the mischief if you think about it. I'll buy it today for 100,000, claim £100,000 deduct, £130,000 deduction, flog it on for 100,000. That would work very nicely without that special rule. So fair enough, I suppose. In the meantime, if you don't qualify for these 130% maximum deductions, if you're not a company, or on top of that, if you are a company, we've got our annual investment allowance. That's £1 million. We already knew that would be £1 million. That stays for companies and unincorporated businesses until the 31st of December 2021. And if you're a company, I suspect you would like to claim the annual investment allowance if you're within that limit for expenditure on special rate pool assets, because you can either get 50% deduction under these new rules or the 100,000 under the existing 100%, sorry, under the existing annual investment allowance limit. So what the Lord giveth, the Lord taketh away. We're going to have much higher rates of corporation tax going forward, but to stimulate investment in the short term, we do have this, what's being described as this super deduction for expenditure on plant and machinery. So all good. Just while we're on plant and machinery, one of the items the Chancellor has been heavily plugging his little pet project are these free ports. They're meant to be 8 set up in England. There were some announcements about capital allowances. I'll mention them very quickly because I can't imagine it's too relevant for just for completeness. 100% enhanced allowances for plant and machinery expenditure. There's a 10% structure and buildings allowances, and also there's SDLT, employers NIC breaks, and business rate incentives for investments in free ports. So watch this space, see how those develop, but I can't imagine too many of us will have clients who are dealing in such areas. Okay, so that's your capital allowances. That's your increase in the rate of corporation tax. Let's just talk about the extension of trading losses. As I said, bit of a double-edged sword. I'll explain what I mean by that in a minute. At the moment, you can generally carry back trading losses 1 year. So that's for companies or unincorporated businesses. There is a 3-year carryback for terminal losses where your business ceases. But now we've got a temporary 3-year carryback for all trading losses. You can carry back up to £2 million of trading losses arising for unincorporated businesses in 2021 tax year and 21-22. That's a £2 million loss for each of those years individually, or for companies for years ended 31 March 2021 and year ended 31 March 2022. And if your year end is, of course, not aligned with the fiscal year, then there's a bit of apportionment to be done. But the principle there is, yes, you can carry back additional losses. You can always go back 1 year, that remains, and that is uncapped. But you've got this additional £2 million that can go back a further 2 years. latest year first, and then you can carry back further if you've still got capacity. If you're in a group, that £2 million has to be apportioned amongst the group, albeit each individual company has a de minimis £200,000 of additional losses. So additional flexibility, good news on the face of it. I think a degree of caution though. Do you want to carry back your losses to earlier years where they'll save tax at 19%? Or are you better off carrying those losses forward into years where we're going to have a 25% corporation tax rate, or indeed into years where you're in that marginal band and paying an effective rate of 26.5% on your additional profits? Now, most of us would say a bird in the hand, I'll carry them back now and generate the cash that my business desperately needs. Absolutely, makes perfect economic sense, but just be aware, as I say, it's not quite as generous as it might seem. But there you go. And in fact, if you have a look at the Red Book, it's actually listed as a revenue raising measure, quite surprisingly, I think, for the reason we've set out. So don't gift horses, etc., etc. Be a little bit careful and think very carefully how you want to utilise your losses for tax purposes, subject to your cash flow requirements. So those are our losses. One of the points that's come out of our departure from Europe, we used to have the Interest and Royalties Directive that allowed for the payment of intragroup interest and royalties gross between the EU and EU companies. Not a huge shock to say we're no longer in Europe. And so that directive is to be repealed from the 1st of June 2021. So no longer has effect. You can no longer automatically take advantage of that where you're paying group companies interest or royalties. Instead, we go back to the treaty rates. It's not, I suspect, going to make an awful lot of difference. We do have the largest treaty network in the world. So in many cases, we do provide for a 0% rate on royalties, certainly. It will affect some interest payments. There may be the requirement to withhold tax now. And do bear in mind, if you want a reduced rate of interest, either under the directive at the moment or under the treaty, you do need to apply in advance in respect of interest. So keep an eye on that. And of course, we're happy to advise depending on individual circumstances. But the headline is treaty rates only will apply going forward. So that's that. Let's move on now, if I may, to a couple of consultations that came out. One of my little pet subjects, R&D. We've had consultations on the past here. We've had many consultations. The last one was looking at whether data and cloud computing costs should qualify. I think the suggestion is it will, but we've nothing definitive on that. They've announced a further consultation looking more generally at R&D, the scope of the relief, what is qualifying expenditure, and we do have the two separate R&D regimes, one for small and medium-sized companies, albeit the limits are very generous, up to 500 employees, for example, and the large company regime, the so-called R&D expenditure credits regime. So a bit of navel gazing here. We're looking at the regime as a whole. Is it targeted at the right businesses? Is it achieving what it wants to achieve? It's a consultation. We'll have to see what comes out of that. So keep an eye on our website. We'll let you know if there are any substantive changes there. In the meantime, let's just flag up the change that does take effect this year that's been trailed heavily previously. This takes effect for accounting periods starting after 1 April 2021, so it's not going to have an immediate effect. But there was concern with HMRC that R&D credits were subject to abuse, particularly where work was subcontracted overseas. It was difficult for them to audit that properly. So if you are claiming the cash credit, if you are loss making, then the amount of cash credit you can claim is going to be capped at £20,000 plus 3 times the company's total PAYE and NIC costs. Again, it's all a bit back to the future, this budget. Many of you recall when R&D credits were first introduced back in, I think it was 2000, there was a cap equal to your total PAYE and NIC costs if you wanted the cash credit. Well, this is more generous, but it is a cap. For many December year ends, it's not going to be relevant until next year. So there you go. That's R&D tax credits. I'd also just in passing mention at one point, we talked about taking dividends or salaries. Of course, bear in mind, if you're an if this is an owner managed business and you are involved with the R&D yourself, it's another reason to take salaries. You can claim the R&D tax credit on your salary to the extent you're involved in the R&D. That doesn't apply if you're taking dividends. So that's one consultation. The only other one I'm going to mention for now is on EMI share option schemes. EMI share option schemes, 4,000 companies granted options in the year to April 19, 34,000 employees benefited, and it is by far and away the most generous share option scheme that's out there. Not got time today to talk about all the advantages, as it were. The good news is the government said they're committed to this, but again, they're having a fairly far-reaching review. It's become a very difficult regime. They've tried to tighten it up as best they see, but now again, they're looking at, well, have we tightened it up too much? Is it targeted at the right companies? Are the limits appropriate? And does it do what it's designed to do, which is ultimately to encourage the retention of staff? There are concerns that it may be doing the opposite as far as encouraging businesses, insofar as if you're about to grow, are you concerned you might go over, say, for example, the 250 employee limit, which would mean you can no longer offer new EMI options? So are these limits a bit of a cliff edge that are discouraging businesses from growing and perhaps holding them back? So again, we'll have to see. The one piece of good news is when we had the furlough rules introduced, and Chris is going to talk us through the new announcements there shortly, there was concern that if an employee had EMI options and went on furlough, were they continuing to meet the working time requirements? You broadly have to devote 75% of your working time to the business in order to qualify for EMI options. So they have now clarified and confirmed, it's coming in the draft legislation in the finance bill, that if you're on furlough, that shouldn't prejudice your entitlement to retaining the benefit of your EMI options. So that's good news, and it's good that that has been confirmed. Now, those are just two consultations. There is a number of consultations going on. In fact, I think there's even a consultation day coming towards the end of this month, where we're expecting further announcements. I suspect this will be consultation on further tax rises in the future. Do keep an eye on our website. As soon as anything is announced, we will, of course, let you know. So those are the consultations. Moving on. Stamp duty land tax. We have had an increase in the basic rate band, the exemption on residential property to encourage property purchases during the current coronavirus crisis. We've got a £500,000 nil ban for residential property. That's being extended until 30th of June of this year. It's then going to drop down to 250,000 until 30th of September. Back then to the old £125,000 limit. So good news. Hopefully that will continue to encourage some movement in the housing market. On the negative side of things, previously trailed a surcharge for non-residents buying UK residential property. That further 2% is coming in from 1 April 2021. So no changes for non-residential, but some good news and bad news, albeit no huge surprises on the SDLT rates for residential property. Right, let's say a few words on VAT. Some incentives here for the hard hit hospitality, holiday accommodation and attractions as far as VAT goes. We're going to have an extension of the 5% rate of VAT until 30th of September. As if our tax system wasn't complicated enough, we're now going to have a new level, 12.5%, that will apply to 31st of March 2022. So it's good news, albeit again some further complications down the line. There was also announced a VAT deferral scheme allowing businesses to pay off VAT that was due between March and June of 2020. You can pay that off in interest-free instalments from this month. So a cash flow benefit to businesses there. And again, if you require further details, we'll be very happy to talk you through those in due course. Do drop us a line. On the direct side, on the business side of things, only the point I'll mention are the changes to the construction industry scheme. These were flagged up previously, but just to confirm what's changing. Entities outside the construction industry stream will now only need to apply for CIS status and registration where their annual construction expenditure exceeds £3 million annually. Previously it was 1 million, so that's good news. The method of calculating or quantifying that 3 million, you look back over your previous 12 months, so that is changing slightly, but again that will keep more non-construction businesses out of the CIS regime going forward. Good news, there's some clarification on the rules governing allowable deduction for materials. What costs can you deduct in working out whether you're in the regime? And HMRC have expanded their powers to amend CIS returns where there's a clear error or where you've been naughty, and giving them greater powers to raise penalties there, as is the general direction of travel. So those are the changes in the CIS regime. And finally, on the business tax, I'm just going to mention a couple of small points. There's going to be a new points-based penalty regime to be introduced from April next year for VAT and from April 2023 for income tax. So much to come, points-based, Chris. So you and your fellow Spurs fans shouldn't have to worry too much about that. Income tax, there's an exemption for employee reimbursed COVID tests that's been confirmed. So a small benefit, but just hopefully avoids too much bureaucracy and petty charges. And finally, as previously announced, the benefit charge is reduced to nil for zero emission vans from the 6th of April 2021. So those are the business changes. As I say, some good news, the headline being the increase in the rate of corporation tax, not till 1st of April 2023 though. So we have a bit of breathing space there, and many small businesses will not be affected by that. I'm going to hand over to Chris now, who's going to talk you through some of the changes to the furlough arrangements. And well, I say changes, but perhaps complete lack of changes to many of the income tax and many other tax limits. So over to you, Chris, to take us through this. Ian's asked about IR35, and I think you're going to cover that in a little bit of time anyhow. Please. So over to you, mate.
So, well, this first slide is the obligatory tax rates and allowances changes that we publish every budget. But of course, on this one, you'll see that we're very static on what's there. There was agreed changes coming into 21-22, very small increases, and that's it. We're fixed in. So not really much to report on this side. You see in the statements that are coming out today, the Chancellor is still sticking to the whole point is that the individual's net pay is not reducing, and that's going to be the party line, it sounds, for the next 5 years, not to reduce the net pay. And of course, there's a lot now coming out linking it to stealth taxes and so on. But that's where we are. It's a factual list, and not too much to really talk about on that slide. So I'll just pick up a couple of other little points, and I was in some ways hoping to talk a lot more in relation to the budget from the personal taxes side, but we just factually saw very little that came out of it. It's a few bullet points that are there. One of the sections that Tony just alluded to mentioned we have the off payrolling rules that are coming in. So I'm sorry if you just flick past on the next slide, please. As I say, most people will be aware from April we've got new off payroll working rules. Otherwise, IR35 legislation affects, and there were two minor tweaks. Some people were hoping for a delay, another extension. There was no mention at all. This was the tweaks were hidden away, and it's basically in relation to supply of information. So it's very minor. So we will see the changes happening, and if the action point, if you haven't dealt with it already and we're expecting an extension, it's not there. And I suggest you speak to us if you've got real concerns on the IR35 point. The basics, it makes sense. Tax exemption on the home office equipment, that was expected. Whilst we're still working at home, it's an extension of what's already there. So nothing untoward there. And then the small point on the cycle to work scheme, one of the qualifying conditions is that the bike has to be primarily used for journeys to the office, and given that not many of us are in the office at the moment, it seems right to extend that essentially, or remove that section for the time being. There's one point I didn't actually make on the slide there, which Tony's previously alluded to, was the losses. For unincorporated businesses, for those sole traders, the extension of the loss relief does include the unincorporated businesses, which is good news actually. That was slightly missed. And ultimately where I'd expect to see it for our clients are those sole traders where, of course, in a 2021 year, if there are losses incurred, you would have been able to carry back to the 1920 year anyway. But of course, 2021 losses, sorry, 21-22 losses that are being incurred, we can go back to the 3 years. So that's some good news on that side, but it's really going to affect those that haven't really been able to trade for this last year or so whilst incurring costs. So that was there. And everything else, it was very minor points. It's not from the personal tax viewpoint. It was really small. So I think with that, what I'll do is I'll come on to the, let's say, more interesting bits on the coronavirus job retention scheme, where we had a little bit of clarification as to where we see a bit of end in sight in this.
All right,
And,
Chris, let's Dan's desperate to have a word. Go on, Dan.
I was just going to say before you move on, I mean, you were saying that the chance of sticking to the party line of no one's going to be worse off as a result of the freezing of all the allowance bands, but I think it's also worth mentioning to his credit that that Mr. Sunak didn't try and hide the fact that it is an effective increase in taxation, or at least in real terms, and that it will raise more money for the revenues coffers. I think a figure of 19 billion a year was banded around or something. So, to be fair to him, yes, you're right that they're sticking to the party line of no one's worse off, but equally he didn't try and hide anything.
Yeah, I agree, and I think it's actually quite a clever way that they've gone about it. In essence, it's quite a nice little touch. Although there's quite negativity coming out in the press today. Personally, I don't see it. I think it's quite a sensible way that he's gone. So we'll move on, say, to the coronavirus job retention scheme, and we have end in sight. I know end in sight Mark II maybe, because we're going back. We thought we were there, and interestingly, for those that can remember, there was a previous mention of a loyalty stroke bonus payment at the end of a scheme for those retaining employees. No mention of that, and maybe that's to come. We don't know. Maybe it's just been completely forgotten about, and given how much has been given, they're just going to let it slide. But we say we do have an end towards, or something to aim towards, and that's September. And quite clearly, you can see from the chart at the moment, the commitment is the full 80% to be met up until June. Employers having the NIC and pension costs as is at the moment, and then we've got a sliding scale to remove. Maybe we will hear something come out as a separate update to say about a bonus, but part of me thinks that that's just going to be conveniently forgotten about at this stage.
Okay.
And then the again, confirmation that was expected, the self-employed income to help the self-employed income support scheme. We were expecting a fourth payment, which has been confirmed, and there's no real changes on the method of calculating that. All remains the same. I think two interesting points, sorry, is the fact that potentially, I think I saw a number of 600,000 maybe coming into this scheme now, or being able to qualify, and that's simply because we've had the submissions of the 1920 returns now, and individuals to qualify for the fourth have to make sure a 1920 return has gone in, and it gives us a comparison. So it covers this pay period is meant to cover between February and April, and it opens up to a lot more individuals. The eligibility is the same as the third grant. There's no different there, but it just brings in a few extra people. The bit that I guess is quite interesting, which is actually moves on to the fifth grant, is the, sorry, I'm just, Tone, can you just flip over?
Yep.
One if you could. Is the turnover test, which doesn't affect the fourth. It's purely on the fifth grant only, and the revenue have also brought in, or bringing in, legislation to actually recover money that's been overpaid, and that will be on the fifth grant. So there's a real key action point here that to make sure you're claiming the right amount, you've got to calculate whether turnover has actually fallen. There might be an expectation, but whilst the revenue have actually put a percentage on that, you need to check the numbers, I'd say, before the claim is made. That claim can be made, or the 5th claim can be made from late July. The 4th is being made late April, but the 5th will be late July. So there's a clear action point there that for those that completing the self-assessment returns, which you will be as being self-employed, they should be looked at early in the year. You know, there's no real reason. Get your records in order as of April, May time, and get the returns in ultimately before you make the claim. And then I suspect the method on this will be you'll be claiming, you'll have to choose which to claim. The revenue obviously won't tell you. And if you do overclaim, there will be legislation there to claim it back. So just be careful on that. We don't know whether there's going to be penalties and so on involved. I suspect not. But please avoid overclaiming if you know that it's not relevant for you.
Okay, Dan, anything to add to that? I know you've been keeping an eye on these support schemes.
Yeah, no, the only one really is just with the self-employed income support scheme is this isn't law yet. This will have to come in the finance bill, but they're proposing that it will be taxable in the tax year in which it's received. So the 4th grant, which covers February, March, April, won't need to be apportioned between the two. If you receive it in February, before by 5th of April, it goes in this tax year, and if you receive it later in April, it goes in. I
think it will all fall into the 21-22, Dan, because it's I think the 4th claim is late April that you can make the claim.
Okay, so
it will all fall into 21-22.
There's no apportionment. Yeah.
I think from a point, I mean, we haven't seen the 21-22 forms obviously, but I suspect or 2021 forms, but I suspect there will be a separate box somewhere on the return to actually put a disclosure of what you've received via grants with their tax bill. I think they won't be included within turnover as such. There'll be a separate entry.
Okay. All right. Thanks for that, Chris. Dan, I think it's over to you now to talk about grants and loan funding that changes were announced yesterday as well. So
yes,
take it away.
Yeah, I mean, I've always, throughout lockdown, I've been keeping an eye on all the various schemes that the government have announced. They're all up on our website, and I would encourage everyone who's listening in today to keep an eye on our website, because whenever anything is announced, we will mention it on our website. But there's really 4 things that were announced yesterday that I wanted to pick up on that will sort of come under this COVID support banner. The first is the restart grants. These replace the what are called the lockdown restriction support grants. There were 2 of those, depending on whether the business was open or closed. They run to the end of March, and then these new grants will replace them. And as you can see, that depending on the type of business, if they're hospitality, leisure, accommodation, personal care and gyms, there are grants of up to 18,000 per premises. Otherwise, for non-essential retail, it will be up to 6,000 per premises. The difference obviously is because non-essential retail can open, I think it's not before the 12th of April, whereas the others follow later in May or June time. The full details aren't there yet. I suspect what will happen is, like with all the other support grants, it will be based on the rateable value of the premises, and typically there's a banding at £15,000 and £51,000 worth of rateable value, and we'll probably see that coming in. So, for example, the non-essential retail might be 2,000, 4,000 and 6,000, but that will go up on our website when it's there. These grants are only in England. There will be equivalent in the devolved administrations, but the details that there only apply in England. They only apply to businesses which had to close during the national lockdown, either the 2nd or 3rd national lockdown, and they don't apply if the business was not mandated to close but chose to close. So they're really intended for businesses which were unable to provide in-person customer services from their own premises. So therefore, unfortunately, firms of accountants are not eligible. Next slide, please. They've also introduced the recovery loan scheme, and this is to replace the CBILS, the coronavirus business interruption loan scheme, and the bounce back loans. And they're not dissimilar. Those are in place until the end of this month, and the new one will come in from the 6th of April, and subject to review is currently there for the rest of this calendar year. And like with the CBILS and the bounce back, the government will provide an 80% guarantee on the new loans to the lenders. The loans are anywhere between £25,000 and £10 million, or if it's asset and invoice financing, it's actually can be as low as £1,000. You can see the maximum terms of the loans up on the slide as well, depending on what type of loan it is. And again, no personal guarantee if the loan is less than £250,000, no personal guarantee on principal private residence. The main thing to stress here is that these are open to all businesses, including those who have benefited from one of the existing guarantee loan schemes. So, for example, the bounce back loan, it was a condition that you couldn't have a CBILS or any of the other types on top of it. This you can, so you can have a bounce back loan and then you'll still be able to apply for one of these new recovery loans.
Okay.
Business rates. The relief on business rates has been extended. There was always a generous rate for retail, hospitality and leisure industries, the current tax year, if you like. There was 100% relief. That has been continued till June of this year. And then for the remainder of the current tax of next fiscal year, so from July to following March, the relief will be, well, he announced it as 2/3, but the legislation seems to only be 66%. So I think he's done people out of 1/3%. But anyway, there's 2/3 of the relief. So that's certainly welcome news to retail, hospitality and leisure. It appears that's also been extended to nurseries as well, although I'm waiting for details on that. There are some caps, £2 million per business if it was locked down on the 5th of January, otherwise £105,000 per business. And the final thing to note on business rates is that a lot of large supermarkets, for example, came under public pressure and repaid the business rate relief that they received. In other words, they paid the rates that they would have otherwise had to pay on the basis that they remained open throughout all three lockdowns. And the government have announced that those repayments will be tax deductible. Because they're voluntary, they wouldn't otherwise be tax deductible, and it would be a bit unfair if they voluntarily repaid them even though they didn't have to, and then didn't get tax relief on them. So that if people have generously repaid the reliefs that they were otherwise entitled to, they're deductible.
Okay, thank you for that.
And moving on, there's one more. There's a new mortgage guarantee scheme. This is for people who only have a 5% deposit on their home, although it's actually anywhere between 5 and 9%. There's obviously a dearth of 95% mortgages out there at the moment. So to encourage more lenders to provide 90 or 95% mortgages, this new guarantee scheme comes in. It's only for residential homes of a value of up to £600,000. But the government will provide a guarantee to the lender. One of the conditions is that the lender have to provide 5-year fixed loans. Obviously, the borrower doesn't have to take that if they don't want to, but 5-year fixes will be available, which hitherto has been very rare for 95% mortgages. And as you can see, it's at the moment until the end of next calendar year, and that is subject to review. The way it works is that the lender will buy from the government the guarantee at a commercial rate, and effectively the government guarantee down to 80% of the value. So in other words, if someone's on a 95% mortgage, the government provide a 15% guarantee. The borrower actually, it gets a bit technical, the borrower is actually in the line for 5% of the 15%. So in other words, 0.75%. But that's not really relevant for the borrowers. Fact is, there's good news out there for it's not restricted to first-time buyers, but first-time buyers, people who are struggling to save a deposit, that there will be more mortgages available to them now.
Great, thanks, Dan. Okay, that brings us pretty much to the end of our slides and the points we wanted to bring your attention. Thank you very much for your questions. Chris, I know you've been beavering away in the background responding to some of them. Are there any points you wanted to share or bring out? Anything of general interest?
No, I mean, some of it, a lot of it were bits ultimately around what wasn't included within the budget. So 60-day exceptional circumstances regarding statutory residency tests, for example. We didn't have much mentioned on there. A lot of questions asking about electric cars concerning 130% relief, which, correct me if I'm wrong, Tone, but I've been saying no, they won't. It's not going to be subject. It's not plant and machinery.
No, I don't think it does. But another question that's come in is about vans. I think vans will qualify. Yeah. So thank you for that anonymous question. Okay.
With Tony, I mean, just one thought. I haven't run any numbers, but it was as you were talking. Actually, I was running my mind. Whether for those LLPs that are potentially going to incur substantial P&M over the next couple of years, is it worth running the numbers in terms of an incorporation side?
We'll certainly have to look at that. I mean, this whole equation has changed. Now we've got a 25% rate of corporation tax. It's a difficult one to answer, but yes, there's a bit of number crunching to be done there. We'll keep an eye on that once we get some clarity. I think the one caveat we should add is all of this is only draft at the moment. It will go through a consultation process, work its way through to a Finance Act in due course. So if there's any changes, please do keep an eye on our website. We'll try and keep you up to date with any other changes that come to light. And as we mentioned before, if anything substantive comes out, the consultations that we're going to have further details on this month. So I think those were the main points. Andrew asked about the availability of the 130% deduction for property businesses. I don't think they will qualify, and thank you, John, for your comments on that, because I think that will count as leasing for these purposes. But if we can glean anything more on that, we will of course share. So unless any of my colleagues have anything further to add, I'll take that as a no. Thank you all very much for joining us. We will be circulating, as I said, copies of the slides and a link to this webinar if you or any of your colleagues want to revisit. For now, do take care. We do hope we'll be able to catch up with some of you personally in the future. And thank you all for joining us for this webinar. So it's back to the homeschooling for me. But for now, thank you again and goodbye. Take care, everyone. Bye now.
Bye.